Folks, we are back at it with our Sunday conversations with a good friend, Mr. Dan Bird, where we look at the stock market, look at the debt markets, look at charts. And the first thing I got to say is, Dan, what the heck happened to the 10-year note? When I leave for Southeast Asia, it's anchored at 3.5. I come back, we're, over 4%. Housing is destroyed. Stock market's destroyed. What the heck's going on? Do you have any charts on the
Mortgage
10-year?
mortgage rates over 7.
Yeah, 7.1. The world is ending.
Maybe you should stop leaving.
I know. It's all my fault. It's all my fault. Do
That's
you by
right.
chance have a chart on that? Oh, you know what
Welcome,
I need to
welcome
do?
back, by the way.
Oh, thank you. I need to actually, how do I've actually forgot how to
I uh I
people.
tried to keep this going while you were gone, doing solo monologues, but
You did great. I watched a couple. The internet was not great where I was
body,
at,
yeah, right.
but I did watch a couple, and I read all the comments. People were very pleased with what you do. They're asking you to keep the midweek updates going, which I would ask as well.
Yeah, I probably will do that.
Awesome.
I just do it
Yeah.
for fun, basically.
Yeah.
I know
And of course,
everybody won't,
you
everyone
need to
won't
start your own
agree.
channel.
Yeah, everyone won't agree, but
Oh
that's
no.
fine. That's what
Yeah.
makes a
No.
market.
Yeah.
And one thing I do want to say right up front, I put this in my newsletter this week too. Um, I want to make it really clear that I am not here trying to predict where the
Yeah.
market's going to go. I don't have a crystal ball. I am not into wizardry.
Hmm.
I don't know where it's going to go. Nobody knows where it's going to go.
Hmm.
If you listen to other people on YouTube and they're telling you they know where it's going to go, then you should be immediately reluctant to continue listening because no one
Yep.
knows.
No one knows.
So I'm not predicting. So if I say I think it's going up and it goes down, people can say, you were wrong.
Yeah.
That's fine.
Dude, I'm wrong all the time.
That's no problem. I don't have
Yeah.
any problem with that.
Yeah,
The
me neither.
most important thing in stock investing, whether you're a trader or an investor, the number one most important thing is that you cannot want to be right.
Yes.
If you want to be right, if you want to prove to people that you're right, you will lose.
Hmm.
I will guarantee that.
Yeah.
The worst thing you can do in trading is want to be right.
Yeah. The other thing I want to say, because I've seen some of the comments, is you have been doing the work that you share with us every week and hopefully twice a week for more than a decade.
Right.
And you put your money to work behind your analysis and your thoughts. This is
Right.
not some game. This is not some click thing that you're trying to become some YouTube rock star. You're just a friend of mine who has an expertise in an area I don't have. And you're gracious enough to try to teach me. Or if they go back and watch your playlist, we talked about you teaching me French, right? Because you
Right.
have skills that I don't have. So, and we're still doing that. And I'm getting a little bit better, but repetition helps. So, yeah, again, you're not trying to predict. You are sharing what you have been doing for more than a decade. And I think it's important to know that you're putting money to work, your personal money to work. And when you're wrong, you miss, but
When
you
I'm
clean
wrong,
it
I
up.
get
You
out.
have stops. Yeah, you have stops. That's the
Right.
magic. That's what I
I get
failed
out.
with 20 years ago is I didn't have those
I
tight
mean, I
stops.
mean, good traders are right 50 or 60% of the time.
Yeah, I would say 55. Yeah,
Right.
roughly.
If you have a doctor that's only right 50% of the time, or a
Go
lawyer that only
go
wins
somewhere
50,
else.
right, you're going to go somewhere else, right? But
Yeah,
that's
I am.
that is a but that's a successful trader,
Yes,
being right
exactly.
only half the time.
Hmm.
Another way to look at it, and by the way, I told you I wrote a screenplay about Nicholas Darvis,
Hmm.
who his book is in my book list on my newsletter. One of the things I put in there is if you flip a coin, if you flip a coin 100 times, what are the chances? What do you think the odds are of those coin flips 100 times?
Well, it's supposed to be 50-50.
50-50, 50%. That's
Hmm.
same thing with a successful stock trader,
Yep.
50-50. But the important thing to understand, and this is statistics, and this is just the way things work, this is the way the world works. So you can apply this to anything. You will get runs of successes.
Yep.
You will get heads over and over again for a certain amount of time.
Hmm.
But when you do, you will also get the same number of runs of tails or
Yeah.
losses. So if you start getting a run of winners, if you start being successful, then you should let your winners run make the most that you can out of your winners,
Mm-hmm.
but don't let it go to your head. Don't
Yeah.
think that you are brilliant or a genius or anything else, because you will get those additional runs of losses by
Dan,
that.
are you trying to remind me of my success of turning 7 grand into almost 200 only to get cocky, arrogant, and stupid and then lose 80% of it? Thank you. That's a very pleasant memory on this Sunday morning.
Well, that's what this is all about.
Absolutely.
That's part of it. And it's really not just trading stocks. It's
Oh, yeah,
running a business. It's life, really.
totally agree.
So
Totally agree.
so
Yep.
you don't try to be right all the time.
I agree. No, the key is
dangerous.
really the key of your framework is you're letting your winners run, but you're having stops to protect the downside, and
That's
you're
right.
right sizing your positions. These are all things
Right.
that, I mean, of course, I intellectually knew, but I didn't practice, and you have
Right.
helped me do that. So
Yeah, position sizing is really important. When the market is choppy, or if the market's going down, you shouldn't be in it. But
mhm.
if it's choppy, like it's actually been the last few months,
Yeah,
then make your position sizes smaller.
yeah, yeah,
Your wins will be smaller, but so will your losses. And then when the
yeah. I
market starts to
mean,
trend again,
your strategy helped me just over the last 6 months or so. I don't remember how long it's been. I got one tranche of JP Morgan when they crashed. I got two tranches of Facebook when they crashed. I got one sub 100 and one sub 90, I think.
right?
What else did I get? I got three tranches of Blackstone. So I think that's it. I may have got one more of something, but yeah, you're helping me,
Good. So in
just
the second session today, we'll look at the dividend stocks that I introduced while you were gone.
okay.
And we'll also look at some individual, because one of the subscribers asked me to look at one particular stock while I'm on with you this morning.
All right. Well, let's
We'll do that
let's
in the
uh let's get into the
second
10-year
session.
first. Okay.
Okay. Let me share my screen. Uh, can you see that? Am I sharing?
I see a Zoom window. There
Okay.
you go.
All right, good. First off, this is the S&P. This is how it ended on Friday.
So what is the green arrow? Is that Thursday close or what is that? Is that Friday
This
open?
green arrow. So you see the pink line across here?
Oh, I
This
see
is
it.
this is the relative strength index.
Oh, okay, okay, good.
During a bullish run, whenever there's a pullback
Mm-hmm.
in a good bullish uptrend, a pullback usually won't go below the 40 on the RSI.
Okay.
So as I said back in October, that was the low. We had a higher low. We've now, I think, put in another higher low.
Yeah.
But notice where the RSI went down to 40 right here and
Yeah.
then bounced back up. It went to 40 here again. Now it's bouncing again.
Yeah, the other thing I thought was interesting is CNBC all afternoon, so post market close, all afternoon my time, post market close, was talking about the market bouncing off the 200-day. And I
Mm-hmm.
assume that's the gray dash here.
It's the gray dash line. And I've said that the last couple of weeks.
Yeah.
When we were coming down here, I said we're going to probably go to the 200-day. That was on. I actually did that on the channel while you were out.
Oh, cool.
I said that a
I
couple of
missed
times.
that.
That I think we're going to the 200-day, and then we'll see if that becomes support.
Mm-hmm.
I think that it will, but it doesn't mean it has to. I mean, it could drop
Right.
through it, but it's a key inflection point basically.
Yep. Yeah.
So it did bounce off of it and had a really nice run for 2 days.
Yeah, the macro thing, obviously you probably know this, but one thing happened, I think it was Thursday afternoon while the market was open, Fed President Bostic
Yeah,
basically came out and said, "Hey, I'm cool with 25," because the
right,
market was starting to lean in thinking a half was coming.
right.
And so I think he kind of decompressed the
Yeah,
market a little bit.
I think the Fed will have a problem if they go 50.
Oh, they can't. They can talk tough. They can do all those things.
Right,
I've told my audience, I believe they're going to Bernanke us to death from here. They're going to give us a quarter and then a
right,
quarter and
right.
maybe a third quarter, but it's either two or three in my book.
Yeah, I
They're going
agree.
to talk tough, but there's no chance of a half. I mean, I want them to do a half, rip the Band-Aid off, as I've said for 9 months, get us to terminal rate, be done, but it's not coming. It's not coming.
No. Um, Look at the accumulation distribution line
Oh my goodness. When did that start?
right back here at
Middle.
this last higher low right here.
So that was in January. Okay. I'm just trying to
Yeah,
get my
Yep, January. Really, December is when it started,
Mm.
but January is when it really took off.
Okay.
And it's just continuing higher. I mean, that's accumulation.
And again, what this tells the novice folks is Wall Street is aggressive.
That's
Buying.
right. Big institutions are
Or buying.
buying when all of the retail traders are selling.
Now, it doesn't say what they're buying. It just
No,
says they are buying.
correct.
Okay.
I mean, there's other ways to determine what they're buying. But we
Right.
can look
But
at some of that.
this chart doesn't say that. Okay.
No, this just tells you that the big institutions are accumulating.
Okay.
In fact, they're accumulating even during this sell-off, this recent sell-off from the beginning of February, right? Accumulation distribution kept going up.
Yeah.
So big institutions are buying while retail investors are getting out because they're listening to the talking heads that are saying the market's going to 3,000.
Yeah, there's a lot of talk of 3,100.
A lot of talk of 31, 32. I mean, 32 is a viable support level.
Yeah, it's a Fibonacci or
probably the
whatever.
last one. Yeah, it's a major Fibonacci level.
Yeah.
It's probably the last one. If it does go down to there, then 3,200 is probably where it's going to stop.
Yeah.
But everyone seems to be talking about that lately. 3,000, 3,100, 3,200.
Yeah, it really started last Tuesday or Wednesday. Yeah. I started hearing 3,200, 3,100 a lot.
Right.
It was very few folks were talking about it 2 months ago, like 1 in 50. Now it appears to be like 3 in 10. There's just a lot of talking heads saying we got to go there. I don't know if you heard All In podcast. They're actually talking about earnings quality. It wasn't great this quarter. That while I think it was 68 or 71% beat, which is below trend, but still better than expected. But the quality of the earnings weren't great. You know, some accounting shenanigans.
Right.
So, you know, that earnings recession may be around the corner. I don't know.
Maybe we'll see.
Maybe we'll see.
I think we're still going to have a soft landing. Or let me put it a different way. Because I said this way back early last year when I talked about the secular bull market.
Yep.
Which I've talked about many times. You know, we're in a secular bull market. They usually last 18 to 20 years. This one started in 2013 officially, and maybe 2009 if you want to start from the bottom. So that takes us to 2029 or 2033, somewhere in that area.
Yeah, makes sense.
And that doesn't mean there won't be recessions, and it does not mean that there won't be bear markets. There will. There are bear markets inside of secular bull markets. And there are recessions, but recessions in secular bull markets are typically short and shallow.
Okay.
So I think we will have a recession. I don't think it will last very long.
I'll go one step further. I guarantee you we'll have a recession. I won't tell you when it's coming. Recessions are natural parts of the business cycle. Could we have one this year? Sure. Could we have one next year? Sure. Could it be the year after? Sure. We will have one.
It might actually be a good thing for the stock market.
Oh, I think it would be a great thing. I think we've got to get through the pain. We got to get to the terminal rate. We got to have a little pain. Yeah. All that stuff.
Before we talk about the 10-year, just in case anybody that isn't already on my newsletter, if you'd like to join, just send me an email to breakpointtrading@gmail.com. And I'll send you last week's newsletter and add you to the list. Every week I put in, what happened last week for the calendar and what's coming up next week.
Yeah, that non-phone payrolls on Friday. Sorry. That's a monster number.
Yeah, I thought it was going to be this Friday because in February it was. Yeah. February it was on the 3rd, and I thought it was the 3rd this month, but it's not. It's next week.
Yeah, and I think all 4 weeks of February, the weekly unemployment claims, like last week, disappointed to the downside. And it's interesting. You have the forecast at 200. What I've seen is 2.25. It probably doesn't matter which one.
Well, it'll probably change. It'll change before that.
Yeah, you have any thoughts on? Do you think we get a revision to the 517? Do you think we come in strong again?
I think we'll come in. I think we'll come in stronger than expectations. I think we'll get a downward revision on the 517.
I think if that happens, I think it's net okay. I think if we don't have a downward revision and we come in hot, that could be a problem.
Right. Yeah, it could be. So that's something that the Fed will be looking at. But again, if it comes in, at 200 or slightly above 200,
Hmm.
it's confirming that the economy is still strong. Although
Oh yeah.
payrolls is the last. It's a
Yeah, it's the
lagging, very
last lag.
very much lagging indicator.
Agreed. We've talked about that many times.
Um,
Yep.
Looking at this is from Lizanne Saunders from Schwab.
Yeah, I like her.
These are the dominoes that need to fall before a recession happens.
Hmm.
So you can see the only two that are green still is the earnings recession, and
Hmm.
then NBER actually declaring a recession.
Right.
And a friend of mine sent me an article that essentially, just to paraphrase it, essentially said the bear market does not end until the recession starts.
Yeah,
And
I've read
my
that.
my point, my response to him was, well, you don't know the recession has started until 7 months, at least 7 months after. So that's not really very helpful. Saying a
Right.
bear market doesn't end until the recession starts. That doesn't really help you because you're
Yeah.
not going to know that for 7 months. I mean, the COVID recession, you know how long it took them to call that recession?
I actually think that was relatively quick, and I still think it was like 5 months.
14 months.
14 months to call the COVID recession.
It took
Oh
them
my God.
14 months to tell us that there was a recession in 2020. So by
That's
the time
hilarious.
by the time you know officially that there's a recession,
Yeah.
the bear market, it will be long over, and
Oh,
the stock market will be well on its way to a new high.
oh, the market will be up 20, 25, 30%. Yeah, exactly.
Right. Exactly.
Okay.
So this is what I had in my newsletter. I put in a little puzzle, and
Hmm.
I understand you figured it out.
Well, I
Is it
called it and I got it right. I was 70% certain, but I did get it right.
right? So I put this. This is the long-term weekly chart. Very bullish chart. Look at that.
Very bullish chart,
Very
except
bullish.
when
Look
you
at.
realize
I mean,
it's the cost of debt.
well, let's not get ahead of ourselves.
Don't
Don't tell
don't
the
give them the
don't tell
answer.
the answer to folks that haven't seen my newsletter.
I'm sorry.
So if you just look at this chart and try to figure out what ticker symbol it is, I mean, you might say Tesla, right? You might say Netflix. You might say
Yeah, you
something that,
might say S&P. You might say, yeah.
I mean, it just keeps going up.
Yeah.
The next one is the daily. Here's the daily chart. Look at that. It's all green.
Yeah.
How bullish is that? This is an incredibly bullish chart.
Yeah. Yeah. Okay. You're killing me. You're killing me.
And that's what it is.
Yeah, it's the 10-year treasury.
10-year
Yeah.
treasury.
Yeah, so
So
I didn't remember that the 10 years peaked at 4.3.
yeah, 4.43. That's right.
Yeah. Yeah, so it got to 4.1, I think Wednesday, Thursday, and then it had a big sell-off Friday after Bostic spoke.
Yeah.
We're
Yeah,
now
there was
sub 4.
a sell-off. That's why I said it may come down some before it keeps going up. But I mean, it's done that before. Look how it's adhering. I use the August low right
Okay.
here as the bottom part of the Fibonacci, and then the recent high up here is the top part. And you
Mm-hmm.
can see how it's kind of adhering to both the Fibonacci as well as the moving average.
Mm-hmm. Yep.
Every time it hits down here, it goes back up. This is a
What
very
is
bullish chart.
the pink dashes? What is that? Weekly or what is that?
This is, let's see, this is a 21 day and a 50 day.
Okay,
And I
2150.
think
Got it.
I think that's no, this might be a 200 day. This might be the 50 day,
Okay.
the
All
pink
right.
one. But it looks like it wants to go back to this 100% level, 4.3.
Hmm.
But if it breaks through that,
Yeah.
the next Fibonacci level is right here,
Which is
five
what?
point 5.45.
Oh, yeah. So a 5, 4, 10 year. Again, what would that mean minimum for 30-year money? So minimum 1.8 on top of that would be 7.2. maximum that would be 2.5, so that would be 7.9.
Mm-hmm.
So call it 8.
Right.
Ugh, yuck. But a peak of 8 certainly sucks, but it's not 9 or 10. I have some people on my channel telling me that mortgage rates are going to 10%, and I'm like, how are we going to get there? But yeah, so what you're showing me is what I think you're telling me is 8's possible. That's what I hear you saying.
For mortgage rates, yeah. I mean,
Yeah,
I've had a mortgage rate of 12 in the past.
yeah, yeah.
What was interesting, by the way, for those that have lived through that period of 12% mortgage rates,
Yep.
which I did. By the way, it was my first no money down deal
Yeah, I
in
like it.
real estate.
Creative
Because
financing. What year was that, if you don't mind sharing?
that was in 1989,
Okay.
and I refinanced my wife's house when we first started dating.
Mm,
That was my first no money down deal.
nice.
It was her house, but
Mhm.
I just moved in with her.
There you go. There you go.
But we had a 12% rate. So interestingly, what was happening then was a lot of refinancing, very quick refinancing. So rates are at 12 and higher, but they started coming down.
Yeah.
So as they came down, probably every 2 years we were refinancing.
Sure.
Came down to 10, they came down to 8, went down to 7. Every time the rates would drop, we'd refinance.
Yeah. The rule of thumb for a long time is if rates go down 2%, you refi.
Right. Yeah. We were doing that every couple of years, refinancing.
Yeah. And so the other thing I wanted to ask you in episode number 1, just catching up on the last month. So not only was the 10-year anchored at 3.5 and then spiked to 4.1 while I was gone, you had long called 4,100 on the S&P.
Right.
And it seems, again, I didn't check every day because, again, we were in another part of the world, but we kind of pivoted around 4,100 the whole month I was gone. Is that a fair memory?
Yeah. Well, 4,100 is right here. So yes, it went above 41. It got to 42 in the beginning of February. So that's right about when you left, right?
About when I left late January. Yeah.
Okay. So yeah. So it went up. It went above 41. It got to 42, and then it reversed, came back to 41, and then dropped through 41, went down to
Okay.
39.50. And I was saying when I said it was coming back to the 200 day, I said it would probably be around 39.40.
Okay.
And let's see what the low was. The low was 39.28.
Okay. Yeah. I'll call
And
that a win.
that's where it bounced. And now we're heading higher, and you can see the channel that it's in right now.
Mm-hmm.
So, I mean, I think early next week, we're probably going to retrace some of this because markets never go straight up.
Yeah. And
Right.
then the
So,
other thing I wanted to ask you, again, just trying to level set, because we do this weekly, but you and I haven't talked in 5 weeks. So we talked about the 10-year, we talked about the S&P. Now, obviously, the S&P 500 is 500 best companies, but have we seen any like out of discretionary into staples, out of tech? I mean, because again, the S&P could not move, but some segments could be whacked.
good question. So these are the sectors. This is Friday. So you can see the 3 aggressive sectors, growth sectors: communications, which is where Facebook is and all the internet stocks;
Yep.
technology, which is where semiconductors and software is; and consumer discretionary.
Oh, that reminds me. The other thing I bought, I knew there was another stock I bought because of you. I bought Snap, and I've been trying to buy round 2 and round 3 of that, but my prices aren't getting hit yet.
Well, the next section, we're going to look at some individual stocks. So we'll look at some of yours, and one of the viewers actually
So
asked me to look at one.
this is Friday, right? Not. Could you look
This
at
is
this for
Friday,
the
so
month?
let's go back a week.
Can you just do the month? Well, actually, I guess weeks first.
Yeah, so
That's
week,
fine.
materials and industrials were leading, but here's the S&P. So you want to key in on the
Anchor on
S&P,
that. Yeah.
right? Because
Right.
everything above it means it's outperformed.
Correct.
So technology, energy's making a comeback, by the way.
Okay. Interesting.
And communication services outperformed. Discretionary was slightly underperforming.
Okay.
Then if we go back a month,
Yeah, just do a month.
now you got the S&P here. So now you've got energy outperforming, materials, industrials, technology still,
Interesting.
consumer staples. So it was quite a mix, and that kind of tells you that the market was choppy.
Mm-hmm.
Went up to 4,200 and went back down below 4,100. Now it's starting to come back up again. this basically here kind of reflects this
Right.
right through here.
Okay.
Just basically bouncing in this channel up and down.
Yeah. All right.
So
Very cool.
we will very likely go back up to 4,200 or somewhere in the top of this channel, 4,250, before we start coming down. And 4,300 is a major resistance level. That's
So
the next
on this
major level we have to get through.
So I mean, I kind of round this out because we do have both of us have a hard stop in about 30 minutes.
Right.
What where does the 3,200 call come from? Is that a Fibonacci level that you could point at for some folks? And
it is a Fibonacci level. I didn't have it up, but I think I could find it.
Yeah, because I think I said this earlier, but over the last since Wednesday, the amount of chatter I've heard about 3,200 has gone up 10x.
Right.
Okay.
So the 60. This is the distance between the COVID low in 2020 is the bottom of this, and the top of this is the high in December.
Okay.
Of 21. All right.
So then, okay, got it.
So those are the anchors for this Fibonacci.
So the 50 is 35.
This is a long term. This is a weekly chart, so it's a long term chart.
Yep.
So 50% is at 3,500. You can see the low was 3,491. Got it there.
Right.
The blue lines are the quadrants. So it basically divides the high and the low into quadrants. Mm-hmm. And you can see the 50% Fibonacci, and the exact middle of that quadrant between the low and the high was at 3,500.
Okay.
That's where it bounced in October. 7 out of the last 14 bear markets ended in October. It's a natural place for a bear market to end right there. The next Fibonacci level below that is the 62% level, which is a very important Fibonacci level. And that's at 3,205. And that's why everyone says 3,200.
Got it.
Because that's a really important Fibonacci level. And
thank you for that.
If there's something that happens, let's say China invades Taiwan.
Yep.
Because that's the next possible, exogenous event. Yeah. Then we could easily get down to 3,200.
Well, I mean, it could be lots of things. We could get a 700,000 job creation on Friday. We could get a CPI that pops up instead of down. There could be a lot of things. It doesn't have to be a war.
I actually don't think those things will send it to 3,200.
Really? Okay.
No, because if we get a 700 in the jobs number, it means the economy is strong. I don't think the Fed is going to be overly aggressive. Maybe they go to 50. I still don't think they will.
I mean, if we get, let's be very clear. So there's two numbers that come out before the Fed meeting, I believe. We get a jobs number on Friday, and I think the next CPI reading is pre-Fed meeting. If that came in,
it is.
If that came in hot, they would. Not that I'm calling this. I'm just trying to paint a vision where I'm trying to paint a vision where the Fed has to rug pull the market. I think it would have to be a 700,000 job creation in February, an upward revision to January, wage inflation going up, and CPI headline and CPI core going up. Not that I'm calling any of those, but if those happen.
If all of those things happen, then yes, they probably would go to 50. CPI is on the 14th.
Okay.
Fed rate hike is on the 16th.
Yeah. So.
And then options expiration is on the 17th. We're right here.
Important couple of weeks. Yeah.
This is from Stock Traders Almanac. But going back over here for a second, so that's where the 3,200 comes from.
Thank you.
I think this is the one I wanted to show on the 10-year. So this is the 10 minus the 2.
Yeah,
this
look
is,
at that.
Inversion
largest gap that I remember.
Inversion. I think
there was a larger
curve.
Gap in 81, but I don't remember what those numbers were.
Well, these charts only go back 21 years, so you can see the one before the 2008. I actually highlighted the recessions. It's also important to understand that the yield curve gets back to normal, back above 0, before a recession happens.
Oh, great.
Happened right here, 6 to 9 months. Happened back here in 2008, 6 to 9 months. So when I was seeing the talking head saying, the yield curve is telling you there's a recession coming, I don't disagree with that. It's been very reliable in calling recessions.
Their timing is off.
But what they don't tell you is that the recession doesn't happen until after the yield curve gets back above 0.
So again, just playing this out 6 to 9 months, basically what this chart is saying is the recession that's being called for, the great, the recession that's been predicted isn't happening till 2024. That's what this
That's
means.
probably right. Probably beginning of 2024. Yeah.
Yeah.
I mean, this yield curve, and what would make the yield curve get back to zero? I'll give you a hint.
Okay.
This pink line right here,
Mm-hmm.
this is the Fed funds rate.
Mm-hmm.
Notice how the Fed was raising.
Mm-hmm.
And notice the yield curve was dropping.
So they got a plateau. They got to pause.
So it plateaued and then started coming down before the yield curve went above zero.
Yeah, they're not cutting this year.
Right. And the same thing back here in 2008. Here's the funds rate, which was higher than it is now. It's 5.25 is what it got to.
Okay.
Then they leveled, it plateaued. The yield curve was below zero. Yield curve went back above zero right here when the Fed started cutting.
Yeah.
In both of those cases, the Fed starts cutting, the yield curve goes above zero, and then a recession happens. The Fed starts cutting, yield curve goes above zero, and then a recession happens.
Yep.
So keep those things in mind. This is another reason, a strong jobs number, GDP is hanging in there. The economy in general is pretty strong. So yes, the Fed would like it to slow down. The Fed would like to see inflation coming down. And here we go. This is the chart. We'll go over this chart next week in more detail, but this is my inflation chart. And you can see already the rate from the last report. So if we move this blue box over, the last report was based on this blue box right here. If we move this over, now that's February.
Right.
Okay. So from the end of January, the CRB came down, even though it's starting to go back up again, but we're in March now, right?
Right.
Move this over like right there. There's February.
Okay.
Gasoline, though, kept going up. Gasoline's higher. Oil is lower and lumber is lower. So most everything is slightly lower than it was.
Yeah, but gasoline is the thing that hits the CPI the fastest. Lumber doesn't hit CPI very quickly.
Right. Yeah, so gasoline's going up, so that will have an effect. But even more importantly is this one.
Yeah, the base effect. I've been trying to tell people what's coming. Yeah.
Look at this base effect. So two things happened on the last report. It came in lower, but not lower than forecast. Came in higher than forecast, but lower than the previous month.
Just a tick. Yes.
Right here. You can see it right here. Went from 6.5 to 6.4. They were expecting 6.2. All right. However, what wasn't really talked about on CNBC and what one of your listeners pointed out is that they revised how they calculate the CPI.
They did. They took it from 2 years to 1 year. Correct.
That's right. And the first time that was reported was the last CPI number. Correct. So that they were expecting it to go up for that reason. And it did. Even though it went down, it didn't hit forecast. But look what happens in the next one. Even with all of those other things, everything except for gasoline is lower, right? But look at the base effect. Look at this huge amount right here that's going to drop off in the next one.
It is. Yeah.
This big one right here from 7.9 to 8.5, that's going to disappear in the next one.
Yeah.
And that's going to cause the CPI to come down. I think it'll be below 6.
Whoa, come on.
Yeah.
So you're talking headline or core? This is headline, I guess.
Headline. Yeah.
Wow. Below 6, like 5 something.
Like 5.9. Yeah.
I'll take the over.
All right.
Okay.
We'll see what happens.
Yeah, I love it.
And if that happens, even with a good jobs number, and I don't think the jobs number will be anywhere close to what it was last month.
Oh, it can't. Yeah.
I'm a little skeptical about last month's job number coming in just before the State of the Union address.
You and me both. You and me both.
So I don't think it's going to come in that strong. I think it might be stronger than forecast, but they'll have a downward revision.
Yeah, I think that's funny. You and I agree. I think it's very rare, actually. People go back and watch our playlist. You and I don't agree on the macro economy very often, but I do. I think the same thing. A January revision slightly down, a strong number, but not a barn burner. And I think CPI comes down. I was thinking 6 or 6.1. I mean, a 5.9, that changes the game. Then the Fed says we're winning. The trend is back at it. The base.
So let me ask you this. Let me ask you this. What if the last one had come in as forecast at 6.2? Then do you think 5.9 would have been possible?
Yes.
So the reason it didn't come in at 6.2 is because they changed the calculation.
I understand. I did the math, actually. Yeah.
Right.
I understand 24 versus 12. Yeah.
Right. So I think this time it will.
Yeah.
Think of it as going from 6.2 to 5.9 instead of 6.4 to 5.9.
Okay. Yeah. We'll, it's going to be very interesting. Yeah. I think a 5.9 markets rip. Markets just rip.
Yeah, I agree. I think
I'm not calling 5.9 just so we're clear, but if it happened.
No, I understand. The next week, you can see here, this is from Stock Traders Almanac. The next week, by the middle of the week, is a big downtrend. This goes back to 1950. But after that, and going into that week of the CPI report, the Fed rate hike, it just takes off. And I think, and the dotted lines up here are for a pre-election year, which is what we're in right now. Pre-election years usually are very strong for the market.
Right. Okay. Well, you know what? We've only got 20 minutes. Show your newsletter one more time, and then we'll go look at individual stocks.
Yeah. So if anyone would like to join breakpointtrading@gmail.com. I talk about a lot of the stuff we talked about here and more on there. And I've got a book reading suggestion list and a bunch of chart links that you can keep. So just send me a note and I'll add you to it. And
thank you.
The next one will be quick. We're just going to look at the dividend stocks and some individual stocks.
Wonderful. Thanks, bud.